Welcome back, inquisitive investors. Today, we've got a seriously fascinating explainer lined up for you. We are looking at a specific kind of setup that, well, it always grabs my attention. We're talking about a company undergoing a massive, genuine structural overhaul, while at the exact same time getting punched in the face by a cyclical downturn. Now, the market almost always sees the punch, but it completely misses the overhaul happening right underneath. We're talking about Lennar Corporation, the second largest U.S. homebuilder, and we are unpacking its true valuation today. Okay, let's dive right into this. So here's how we're going to break this down. We'll start with the ugly cyclical surface, move to the hidden structural overhaul, check out the capital return machine, objectively weigh the genuine bear case, factor in an unavoidable secular tailwind, and finally evaluate the setup at $85.
All right, part one, the ugly cyclical surface. Let's look straight at the macroeconomic reality. And hey, we are not going to sugarcoat a single thing here.
Right now, Lennar is sitting at roughly $85 a share. It's hovering near multi-year lows, and there is just no denying it. The housing market right now, it's absolutely brutal. Mortgage rates have been incredibly stubborn, affordability is a literal crisis, and homebuilders across the board are feeling the squeeze. If you just glance at Wall Street's surface-level view, it's pretty easy to see why the consensus is overwhelmingly reduced. Gross margins have compressed from the low 20s down to about 15%. Earnings per share cut in half. Net profit per home also chopped in half to about $19,800. But, and this is the kicker, the reality underneath that surface-level panic is that Lennar isn't just riding out a storm. They are a structurally completely different company, executing a total overhaul from the ground up. Moving on to part two, a hidden structural overhaul. You see, the Lennar of today operates absolutely nothing like the Lennar of the past. You really can't properly analyze this company without getting into the head of Executive Chairman Stuart Miller. First of all, Miller holds roughly 9% of the economic ownership. That means if the stock drops 50%, he personally loses over $1 billion. So he has absolute massive skin in the game. But what's incredibly refreshing is his no-nonsense approach. He doesn't dodge margin questions or try to blame the Fed. He openly calls margins a shock absorber. It's something the company is deliberately willing to sacrifice to keep selling homes and moving inventory. Now, what's genuinely fascinating here is the sheer scale of this transformation. Historically, home builders were essentially just land speculators. They'd buy billions in raw land, and if the cycle turned ugly, well, they were stuck holding depreciating dirt. And that is exactly what nuked the industry back in 2008. But Lennar, they took a blowtorch to that old model. In 2025, they completed the spinoff of Millrose Properties. Today, Lennar acts much more like an asset-light manufacturer. They buy finished home sites on a just-in-time basis through option contracts. Less than 5% of their land currently sits on their own balance sheet. And the proof that this overhaul is actually working, it's right there in the data. Just think about these metrics for a second. These slash their homebuilding inventory from $20 billion all the way down to $10.5 billion. They've optimized their processes so well that they've achieved a record low construction cycle time of just 122 days. And their inventory turns ramped up from 1.7x to 2.5x. They control the land without actually owning it, and they build incredibly fast. All right, section 3, the capital return machine. Let's see what happens when a massive company becomes this operationally efficient. Let's look at the financial armor Lennar has built for exactly this kind of cyclical trough. We're talking $9 billion in total cash and short-term investments. They have total debt of $5.3 billion, and every single cent of it is fixed rate. Their $3.1 billion revolving credit facility hasn't even been touched. Their covenants cap leverage at roughly 60 to 65%, and right now, they're operating at a tiny fraction of that limit. Plus, there are zero maturity walls in sight. Honestly, they could sit in this margin trough for years without breaking a sweat. And this brilliantly illustrates what they're actually doing with all that free cash flow. While the broader market is stressing out over margins, Lennar's share count is just evaporating. They have reduced their diluted shares outstanding from 309 million in 2021 down to 244 million in Q1 2026. That is a 21% haircut. Buybacks are outpacing stock-based compensation dilution by more than 10 to 1, and they are doing the whole shebang with free cash flow, not by borrowing. Which brings us to section 4, the genuine bear case. As intelligent investors, we absolutely have to flip the coin and impartially weigh the negative catalysts. These threats, they're distinct and they are very real. First, if mortgage rates decide to camp out at 6% or higher, those ugly 15% margins and heavy sales incentives might just become the new normal. Second, their even flow model, meaning they build continuously regardless of demand, could force them to clear standing inventory at a massive discount if demand completely freezes. Third, there are significant quality control issues. There's a massive 2025 lawsuit from the Seminole tribe over 550 plus allegedly defective homes, right alongside persistent warranty litigation across the Sunbelt. Fourth, remember that Millrose spinoff we praised earlier? Well, CEO Stuart Miller sits on both sides of a $500 million annual payment stream in option fees. And finally, the dual-class share structure gives the Miller family absolute control, despite independent shareholders voting heavily for a one-share, one-vote system. Okay, Section 5, the unavoidable secular tailwind. To get the complete picture, we have to zoom out from the cyclical miseries and company-specific risks to the broader macro environment. So the absolutely crucial point here is this number, 4 million. That is the size of America's accumulated structural housing deficit. And guys, this isn't some abstract projection, it is a physical reality. For over a decade since the 2008 crisis, we have consistently underbuilt. Homeowner vacancy rates are currently sitting below 1%. You have 1.8 million millennials and Gen Zers who simply can't afford to form households yet. That right there is a coiled spring of pent-up demand. On top of that, you have the lock-in effect. I mean, think about it. Millions of existing homeowners are sitting on sub-4% mortgages. They are just not going to sell simply to take on a 6% rate. This effectively chokes off existing home supply, funneling desperate buyers directly into the new construction market. Finally, Section 6, the setup at $85. Let's bring this whole thing together. You know, a lot of analysts knock Lennar for those 15% margins, especially when competitors like PulteGroup are posting 24% margins. But you really have to look at how they achieve that. Pulte cut their housing starts by 13% to match softer demand. Lennar made a deliberate strategic choice to do the exact opposite. They are aggressively pushing volume over margin. Why? Because keeping the factory running preserves their subcontractor relationships, holds their market share, and keeps their community pipeline flowing. Sure, it looks a bit ugly on the margin line now, but it sets them up for a massive earnings snapback when affordability finally normalizes. Let's move to their accounting and see how this builds your confidence in the actual numbers. Because for a company operating in such a complex, cyclical space, Lennar's accounting is exceptionally clean. They've had the exact same auditor, Deloitte, since 1994. They use conservative, single point-in-time revenue recognition, meaning they literally don't count the cash until the home closes. Best of all, in a recent quarter, their non-GAAP adjustments actually made their earnings per share look worse, just to provide a more conservative picture of core earnings. The books are incredibly clean. Which leads us to our final thought for this explainer. If you have the patience to look past the cyclical noise and hold for a 3 to 5 year horizon, what are you actually getting for $85 a share? Well, you're buying a $30+ billion revenue machine, you're buying $9 billion in liquidity with very minimal debt, you are buying into a management team with incredible skin in the game. Yes, for sure, the margin trough is painful, and those quality control issues demand hard scrutiny. But the company underneath all that noise is fundamentally rebuilt and operating on the right side of a massive decade-long housing shortage. So does it look like a value or a value trap to you? I'll let you be the judge. Thanks for joining me on this explainer, and keep learning.